course, we discussed the RBI policy. Last week, we had the RBI policy where they unanimously retained the repo rate at 5/4 and maintained the neutral stance, signaling no urgency to respond to the recent rise in headline inflation. They lowered their FY27 inflation forecast by 10 basis points to 5%, and they increased the growth estimates by 10 basis points from 6.6 to 6.7%. But being any major change in the current monetary policy, the current monetary policy was widely expected, where the market participants expected RBI to maintain their rates. What market participants were also expecting RBI were to probably acknowledge the inflationary pressures which are in the economy because of El Nino, as well as because of higher commodity prices. So what we saw in the US, what we saw in quite commodity prices, we saw long end bond yields getting punished in those economies. We saw some pressure on yen as well, where in fact the US Treasury had to sell their euro holdings to appreciation under check. So given these kind of global factors, it was expected by some market participants that probably RBI, if not take any rate action, but they will probably sound a little concerned on rising inflationary pressures, whether due to commodities or due to food inflation, and they will be slightly mindful, especially if you look at RBI CPI forecast, and if you look at the table on the left-hand side, if you look at the Q3 CPI forecast is 5.9, Q4 5.5, and the first quarter of FY28, that means till June of FY28, they are looking at an inflation which is higher than 5%. Their target is 4%. So given that they expect inflation to average around 5.5 for next 9 months, where the repo rate is 5/4, the market participants expected RBI to sound a little concerned on inflation and probably signal some hiking at some point of time. But RBI remained quite sanguine. RBI distinguished between the first round impact of supply side shocks, whether it's oil price or food prices due to El Nino, but a more persistent generalized inflation which feeds into core inflation. So RBI kind of differentiated where that the current inflation, which is expected to move from 3.9% in the first quarter of FY27, close to 5.5% for the next 9 odd months. That is largely rising due to higher commodity prices, but they are not seeing any major impact on core inflation, and hence they are unlikely to change their stance, and they are not very concerned on high inflation, which market took it quite positively that probably RBI will not hike. We still expect RBI hiking by 50 to 75 basis later in the cycle. We do expect a pause in the near term. We think RBI is again neither hawkish or dovish. We think right now RBI, given the fluid nature of geopolitics, where oil went to 120 in May, only to come down to 70 in June, and again, there are expectations of de-escalation between US, Iran, and other economies in that region. Probably RBI wants to really wait for second round impact of this data to really assess how much it really needs to act to control inflation expectation, whether inflation expectations are building up in the first place. So probably it wants some impact. It wants to see the impact on core inflation. Then only probably RBI will want to take any action. So we think the bar for rate hike will remain high. So while we can't say, when the RBI would like to hike, obviously it's a judgment call when they see there is a second round impact. But yes, just because the inflation is mechanically at 5 or 5.5 does not mean that RBI will want to hike or RBI will hike. Probably they will wait for core inflation also to start going up. And mind you, RBI also distinguish between core inflation and core inflation X of precious metals. We may be aware that the current core inflation also has components of gold and silver. So while the current core inflation is around 4% plus, but if you strip out the effect of gold and silver, Actually, core inflation ex of precious metal is close to 2.5%, which is well below the target of 4% of headline CPI for RBI. So broadly, what RBI is trying to say that if you look at really core inflation and strip out the gold and silver effect, the underlying inflation in the economy is quite low, and hence they do not need to see any need of rate hike. Secondly, on the liquidity part, if we would recall in 2013 when RBI had announced TFC in our window, we saw significant flows coming in the banking system in a very short span of time, which RBI had to sterilize. So, of course, there was a concern in the market that whether RBI will currently sterilize these liquidity because of FCNR flows, which RBI clarified that they will not look to sterilize those flows of liquidity because ultimately, in every second half of the year, there is a natural currency leakage. So, currency will leak out from the banking system regardless. So by March and next year, anyways, some of that liquidity will naturally go down. And hence, RBI was not very concerned about the liquidity, which gave further comfort to the market that neither RBI is looking for any rate action in the near term, neither looking for any liquidity actions. Broadly, it is quite, it bodes quite well for the bond market because both on the monetary policy and on the liquidity, RBI remains quite sanguine. And when you have a period of pause in the monetary policy coupled with easy liquidity, that always goes well for short end of the yield curve.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.